In the Price Action Roadmap video. This is our 5th video in the Price Action Roadmap series. We have already covered all the previous topics, and the links are available in the description. So today, as we follow the same roadmap, we will discuss candlestick patterns under basic price action, focusing on Dragonfly Doji, Gravestone Doji, Hanging Man, and long wick candlesticks. Let's start by learning about the Dragonfly Doji. A Dragonfly Doji is a single candlestick pattern consisting of just one candle. At the time of its formation, sellers push the price down after the candle opens. But buyers enter the market at lower levels, pushing the price back up, closing it near the opening level. This means sellers have failed to keep the price down, and buyers have taken control. As a result, a long lower wick forms on the chart, creating a Dragonfly Doji which looks like a dragonfly. In this candle, the candle body is almost non-existent, while the lower wick is much longer than the candle body. The Dragonfly Doji represents rejection from the lower levels in the market. Additionally, the color of the candle doesn't matter. It can be either red or green. Sometimes it may even have a small upper wick. Now let's look at an example. The price faces rejection from the lower level and forms a long wick candle on the chart, known as a Dragonfly Doji, signaling a bullish reversal. This suggests that the market is trying to create a support level at this point. Buyers are continuously trying to push the price upward, causing the price to trade within a range for a while. As the sellers fail, buying pressure increases, and the price breaks out of the range with a strong green candle. If a green bullish candle forms after a Dragonfly Doji, you can enter a long trade by placing your stop loss below the support area. The chances of market reversal increase if the Dragonfly Doji forms near a strong support area. Now let's understand the Gravestone Doji. The Gravestone Doji is also a single candlestick pattern. Buyers initially push the price up with strong bullish sentiment, forming a strong green bullish candle. However, at higher levels, sellers enter the market and push the price down, closing it near the opening level. This creates a long upper wick with a small candle body, forming a Gravestone Doji candle. In this pattern, the candle body is much smaller compared to the wick. As buyers lose strength, sellers overpower them and pull the price down. The Gravestone Doji acts as a bearish reversal signal. Now let's look at an example. The price moves down for a bit but then finds some support and moves upward. However, it fails to break the high and faces rejection at that level, forming a Gravestone Doji with a long upper wick on the chart. Here, buyers attempt to push the price up from lower levels but fail to break the high due to weak buying pressure. This means the high level is acting as a strong rejection point in the market. A while later, the price breaks the swing low with a strong bearish candle and moves rapidly downward. Now let's understand the Hanging Man candle. The Hanging Man is a single candlestick pattern. When the market is in a short-term uptrend and the price approaches its nearest resistance area, sellers enter the market as soon as the candle opens and push the price downward. However, the price recovers and closes near the opening level, at lower levels. Buyers are strong and push the price sideways, but as soon as the price reaches the resistance area, sellers start entering the market at higher levels. The price breaks below the Hanging Man candle's low and drops rapidly. You can enter a short trade by placing a stop loss above the high of the Hanging Man candle or just above the resistance level. Now let's understand how to trade multiple long wick candles. When the market is in a downtrend and the price approaches its nearest support level, multiple long wick candles may form on the chart. This suggests that the previous trend is slowly weakening. Sellers are actively selling from higher levels, which drives the price down, forming big bearish candles. However, as soon as the price reaches the support area, it faces rejection from lower levels, resulting in long wicks on the candles. This means selling pressure is gradually decreasing near the support area, causing the price to trade in a range. Observing the seller's weakness, buyers start entering the market, and the price breaks out of the range, moving upward. Let's look some of the examples and tips in the chart. Example 1. Dragonfly Doji. Let's imagine you're checking the market, and after a downtrend, you spot a Dragonfly Doji. This candle looks like a T, with a long lower wick and almost no body. What's happening here is that sellers tried to push the price down, but buyers stepped in and brought it right back up to where it opened. It's a classic sign that buyers are gaining control. Tip: don't rush into a trade just because you see this pattern. The smart move is to wait for a bullish confirmation candle. If the next candle is strong and green, it's a good sign to go long. Set your stop loss just below the low of the Dragonfly Doji to protect yourself in case things don't go as planned. Example number 2, Gravestone Doji. Now let's say the market has been going up, and suddenly you spot a Gravestone Doji. This candle looks like an upside-down T with a long upper wick. What's happening here is that buyers tried to push the price up, but sellers came in and pushed it right back down to the opening price. It's a signal that the market might be ready to reverse. Tip: for the Gravestone Doji, look for confirmation. If the next candle is bearish, it might be a sign to go short. You can set your stop loss just above the high of the doji. Remember, patience is key here. Waiting for that confirmation can help you avoid false signals. Example number 3, hanging man. Picture this. The market's been on a nice little uptrend and you spot a hanging man. This candle has a small body and a long lower wick. It tells us that sellers tried to push the price down, but buyers managed to bring it back up. However, this can be a warning that the market's momentum is weakening. Tip: if the hanging man appears near a resistance level, be cautious. Wait for a bearish confirmation candle before entering a short trade, and as always, use a stop loss, in this case, just above the high of the hanging man. You're protecting yourself from those quick, unexpected moves that could go against you. Example number 4, long wick candlesticks. Let's say you notice several candles with long wicks forming at the same level on your chart. What this usually means is that the price is getting rejected from that level again and again. Sellers or buyers are defending that area strongly. Tip: if you see long wicks near a support or resistance zone, it's a sign that something's about to happen. A breakout could be around the corner. Wait for the price to break out of that range and then enter your trade. You can place your stop loss above the long wicks if you're going short, or below them if you're going long, to stay safe. Bonus tip: always wait for confirmation. One of the biggest mistakes traders make is jumping into trades too early. Candlestick patterns are powerful, but they need confirmation from the next candle. Waiting for that extra bit of proof can save you from false signals and improve your chances of a successful trade. Candlestick patterns like the Dragonfly Doji, Gravestone Doji, hanging man, and long wick can give you a lot of insight into what's happening in the market. Just remember to be patient, wait for confirmation, and always manage your risk with stop losses. If you found this video helpful, make sure to hit the like button and subscribe for more trading tips. Thanks for watching and see you in the next one.